This week, senators start debating the latest version of the financial reform proposal. Does it go far enough in fixing the banking system? Rebel Cole of DePaul University and Michael Iannaccone of MDI Investments here to debate the topic. Welcome, guys. Let's start with more power to the Fed. Could we really be facing this? Under this proposal, the Fed would oversee large financial companies, not just banks. And basically, the next AIG would be regulated by the Federal Reserve. Rebel, let me get your take on that.
I think the Fed failed miserably as a regulator during the recent crisis. Rather than combat too big to fail, they stuffed banks inside of banks. They let Goldman Sachs and Morgan Stanley convert into bank holding companies. I think it's a bad idea.
But Michael, do you think it's a good or bad idea to give the Fed more power?
I think somebody has to be in charge of the larger conglomerate type companies, and I don't think the FDIC has shown any great aptitude to handle that. So to say that the FDIC should have it because the Fed did a poor job, I think you just have to get the proper expertise in place to be able to understand the products and to manage the products.
I don't know. I mean, it's a big question for me because the Federal Reserve couldn't figure out Bear Stearns or Lehman Brothers. How is it going to figure out the next AIG?
Well, it'll be nice if they adopt the Volcker rule and separate investment banks from the commercial banks. One of the big problems is these institutions have gotten too complex and too interconnected, and we need to separate commercial banking from investment banking and commerce and go back to the way we were before Glass-Steagall.
That Volcker rule, I want to go over that. It would prohibit banks from proprietary trading, hedge funds, and private equity funds investments. Michael,
yes,
what's
well,
your take on
I
that?
would agree that we should go back to what the Glass-Steagall Act had, which was a separation of powers in that regard. But again, I think we have to give the authorities a chance to learn, and we have to put the proper people in place. I think the problem with the FDIC is the FDIC likes to look at everything as one flavor, if you will. So big banks, small banks, medium-sized banks, if you're going to give them bank holding companies, they're going to try and apply the same rules to everybody, and that's not going to work. And it's very difficult for them to understand the other subsidiary companies that bank holding companies have. I think you have to have somebody outside of that mentality, the FDIC mentality, to understand that. But clearly, I think both Rebel and I will agree, you can't take people that are already working there, move them around, and call them a new division or a new company. That doesn't change anything.
Okay, let me get to the issue of these complex instruments. We're talking about credit default swaps. Rebel, what do you think this bill does as far as regulating those?
The credit default swaps are at the very heart of the crisis. They allowed Wall Street to gamble on the housing market and more recently on Greek debt. What this bill will do is to at least provide some transparency there. These are typically over-the-counter bilateral contracts, so there'll be some accounting for who has them and what the exposure is. This is what caused the meltdown in the financial system. There'll also be some requirement for collateral, which wasn't done before. This is actually the collateral requirements are what brought AIG down. So at least we'll know what's happening now.
Michael, what do you think about the complex instruments and the regulation of those?
The easiest way to understand credit default swaps is to think of them like insurance contracts, though anyone who sells them will tell you they're not an insurance contract. But they're very much like insurance, and they should be treated like insurance, and they should be regulated like insurance.
Should we allow speculation in credit default swaps?
The only people who should be allowed to purchase credit default swaps should be the people who have the risk, who hold the underlying asset. The whole problem was allowing speculators to buy credit default swaps against subprime mortgages when they didn't own subprime mortgages. The losses on subprime mortgage-related securities are larger than the entire subprime mortgage market.
Yeah, Michael?
Well, I think if you're going to start limiting what people can buy and what people can sell, then you can get into, commodities, and people buy and sell commodities without actually taking possession of the wheat or the corn bushels that they actually own. And, I hate to make this analogy between casinos and Wall Street, but, the credit default swaps bets and the commodity bets without owning the underlying commodity is like doing side bets at a craps table. And, if you start, that's the whole basis of trading in the markets is assessing the correct risk and making the bet, whether you actually own the property or not.
We need to separate the investment side, the casino side of the banks from the commercial bank side. And if we could do that, then you might let the casinos gamble, but don't let them trade on the deposit insurance.
No, I agree with you there. The deposited insurance is a FDIC subsidy, and you shouldn't allow people to use the FDIC subsidy for low-cost funding.
Okay, I want to get to this. Failing companies, firms would have to pay into a $50 billion fund, and the government would use that money to break up companies. Now, that just sounds like a drop in the bucket compared to how much we spent to fix this crisis.
AIG is, what, 160 billion
Yeah.
plus 50 billion. We need a bigger boat. It's not enough.
Michael, is it enough?
No, it's not. It's not enough. The first two institutions that failed in 2009 made up $38 billion right there. So I don't know where they're coming up with these figures. They need. We're talking about multiple hundreds of billions of dollars needed to fix the financial crisis.
Exactly. I've got to leave it there, guys. Thank you so much. Rebel Cole of DePaul University, Michael Iannaccone of MDI Investments. Thank you.